Wall Street getting hammered on Thursday afternoon as Treasury yields surge. Got the Dow set on pace to close lower for the first time in 6 days. Let's find out what's behind all this, and I'll get some stock picks as well from David Spica. He's president of Guidestone Capital Management, and he joins us via Skype from Dallas, Texas. Welcome, David. So what happened today? What were the economic numbers, the data on factory orders, jobless claims? Was it just too strong for Wall Street's tastes?
Yeah, I think the entire week has been representative of what we're starting to see, a pretty classic conflation scare. Chairman Powell has been very clear that he's not going to be impacted by politics in his plans to raise interest rates. And if inflation starts to spike, driven by wage gains, which largely could be a function of what's happening at Amazon and with a very strong job market, that's something the market doesn't want to see. The fear is that the Fed gets ahead of itself, raises rates too fast, creates a mistake, and causes a market correction.
As for Treasury yields, you got them spiking today as well as on top of what it did yesterday. How high are you worried about that? How high do you see yields going?
Wow, the expectations or the projections are all over the place, Fred. Above 3% makes perfect sense in this environment. It gives us a little steeper yield curve. But if you think about it, if the Fed's going to raise Fed funds rate to 3.25, which is what the dot plot shows, you'd expect the 10-year to be well over 4%. So it's something to keep in mind, and I don't think the market's prepared for that. The market is not prepared for rates moving that fast or that high, and so it's something that we're going to have to adjust to. And if the Fed does get moving faster than the market expects, again, as I said, that volatility we've been looking for is going to present itself.
What about your outlook in terms of the equity markets? We're in October right now. We're ahead of the midterm elections. Where do you see stocks headed at this point?
Well, seasonality clearly favors stocks. The economic environment, the earnings environment clearly favors stocks. But at the same time, we are in the longest bull market in history. We do have a very controversial midterm election coming up. The Fed is very much in a rate hike cycle, along with the ECB. The Fed is going to increase the amount of debt that rolls off the balance sheet to $50 billion this month, so that'll further put pressure on liquidity and on sentiment. And so all of these things, I think, could play a factor. I really wouldn't be surprised if we don't see the traditional fourth quarter rally. We see more sort of volatility and angst coming out of investors.
Given the scenario that you described, David, what do you recommend investors do at this point in terms of shifting perhaps asset allocation?
Yeah, I think investors need to be looking at asset classes that do perform better in volatile environments, such as liquid alternatives or low volatility equity strategies. I think the bond market's a little bit of a dangerous place to be right now. If you're going to be in the bond market, you should be probably shorter duration and less focused on credit and more on treasuries. However, if you're going to stay in the equity market, I think you need to look at sectors that tend to perform better in volatile environments, and that would include sectors such as healthcare. Of course, financials are going to do well as the yield curve steepens, and then even that long forgotten, much hated consumer staples sector. I think you may start seeing some rotation into there as well.
Yeah, you talked about financials earlier. A lot of strategists have been talking of financials throughout the years, given the rate rise environment. Yet we haven't seen much movement until maybe yesterday and today. You think it's going to stick now, the rise that we're seeing today?
Yeah, fundamentally, the financials are in good shape. There's a positive regulatory environment that should support financials. And of course, the steeper yield curve supports profitability for financials. So I think it's a pretty good bet at this point. Valuation is very attractive. The market is looking for new leadership outside of technology. And I think financials might be a good place to go.
And take a little technology off the table, perhaps?
I think it is wise to look at taking some technology off the table, particularly as we go into earnings season, Fred. You saw what happened in the second quarter when Facebook and some others missed earnings and how badly they were punished. That has the potential to happen again because expectations are very, very high in the technology sector. So taking some of those gains off the table right now probably makes some sense.
All right, and stay perhaps a bit defensive. Go to rate-sensitive stocks. Thanks a lot, David, for your thoughts.
Thank you.
Our thanks to David Spica of Guidestone Capital Management, joining us via Skype from Dallas, Texas. I'm Fred Katayama, and this is Reuters.